Hello everyone. I hope you are all able to hear me and I hope my audio is very much audible to all of you. Please confirm and type a yes in the chat box. We are here for the CA final intensive mentoring program for the September 2025 examinations. Perfect. I can just check my audio here and it looks very clear, but just you also confirm if you all can hear me clearly. And I hope everything is absolutely fine for all of you. Yes, friends. Good evening, everyone. So, welcome to session 2 of CA Final AFM mentoring. Now, let me explain to you the purpose of this mentoring program. Point number 1, I have given you a proper study plan. Point number 2, I want to make sure you follow the study plan. Point number 3, we will do 3 mock examinations at the end of this mentoring program so that you get a very good grip on the entire subject. Point number 4, after that, you will go write the exam, you will clear the exam, and the day you clear the exam, you will send me a message telling me that you have actually got excellent marks. Good evening, everyone. Good evening, Meerab. Good evening, Subisha. Good evening, Sharat, Ambadi. Good evening, Deela, Yogaraj, Adarsh. Good evening, everyone. I hope you're all doing very, very good here. And I'm so happy to see you all. So now shall we begin our CA final AFM mentoring program, friends? Yes. So as I had told you earlier in the previous mentoring program session also, the main objective of this mentoring program is that you should be able to score 70 plus marks in the upcoming AFM examination. Point number 1. Point number 2, as a faculty, I should be available for you to give you all the guidance and support that is required by you. Point number 3, if I give you an assignment, you should do it very, very strictly, and I should be monitoring your performance and give you an update about how things are actually working out. Everybody clear with this part? Yes. So, friends, week 1, the target that was given to you was bond valuation and share valuation. So now it is time for me to actually review this with all of you. And for reviewing this, friends, by now I believe all of you have installed the app. I'm going to give you access to another free batch where you can revise the topics clearly. So please take my app now. All of you, please take my app. In that, you will have to search for a word called as AFM success. The batch code is AFM success. So just request for a batch code of AFM success. Once you do that, you will get access to some of my premium lectures over here, okay, which I'm providing free of cost as a part of mentoring program. In this, we will revise the concepts quickly together. So friends, what I have done over here is that I have made a simple handwritten notes here that you all can see on the board. In this note, I will be revising all the topics one by one. These topics are covered in my mastery book and also covered in my ODBE book, for which if you're one of my past students, you have free access. But if you are a student who's attending the mentoring program for the first time, in that case, for you, there will be some charges to just buy the ebook. I think it's around 499 rupees. That's just so that you value the mentoring program and just so that you can study along with me and we can score excellent marks in the upcoming AFM examination. So friends, are you all ready? Shall we start revising the concepts of the basics and also security valuation? Please type a yes in the chat box. I'll wait for a minute. Fantastic. So let me begin now, friends. So let's start with the first concept, NPV. The full form of NPV is nothing but it is present value of inflow minus present value of outflow. In a very, very simple terms, if NPV is positive, we should accept the project. If NPV is negative, we should reject the project. Okay. Point number 2 is going to be cash flow. So friends, cash flow is found out using the formula PAT plus depreciation minus additional working capital minus capex. So here you take the PAT, you add back the depreciation, you reduce the additional working capital. From a cash flow point of view, friends, that is nothing but the operational cash flow. Then what you do is you reduce the capex. So you get the cash flow. Friends, in all the chapters of financial management, we don't worry about the profits. We only worry about the cash flows, because ultimately what matters the most is your cash flows over here, friends. Shall I go to the next part now? Next, you have to learn about discounting factor. Discounting factor is nothing but it is investors' expectation. If I am putting my 1 crore in one business, had I put the same money in my father's business, I would have got 12%. Now, when I'm putting this money over here, I should at least get 12% return. So 12% becomes my discounting factor. Is everybody clear with this part now, friends? Next, profitability index. Profitability index is nothing but it is present value of inflow divided by present value of outflow. When you work out NPV, it is present value of inflow minus present value of outflow. This is present value of inflow divided by present value of outflow. So here you get for every 1 rupee of investment, how much money you are getting back. Everybody clear? So higher the profitability index, the better for the company. Everybody clear with this part? Next, then we went to a chapter called as security valuation. In security valuation, you are having two parts. One is called as the bond valuation, and the second one is what we call it as the share valuation. Now we are starting first with what? Bond valuation. How do you value a bond? Value of a bond is nothing but it is present value of future cash flows that the bond can generate. Next part is coupon. Friends, coupon is the fixed payment that is paid to you as a part of the bond. So that is always on the face value and not on the market price. Then we learned about a concept called as yield. Earlier we learned about discounting factor. Discount factor is nothing but it is the investor's expectation. Exactly like that, discounting factor is bondholders' expectation. Now the bondholders' expectation can be found out using 5 formulas. These formulas are used in different circumstances, in which the first one is what we call it as the current yield. So when you speak about the current yield, this is normally used in case of perpetual bonds. Okay, so the formula for current yield turns out to be coupon amount divided by current market price. So if my market price is 90, my coupon rate is 10, I am getting 11.11% return on my particular bond. Okay, so that is normally for what? Perpetual bond. Then you learn about bond equivalent yield. This is normally used in case of zero coupon bond. So in case of zero coupon bond, the formula what they use is discount amount divided by current market price. So higher the discount, higher will be the yield that you are going to get over here. Everybody clear with this part? Next, we learn about effective annual return. Friends, effective annual return is nothing but it is 1 plus y whole power n minus 1. So when you do bond equivalent yield, we do it without compounding. But when you are doing effective annual return, you do it with compounding. Friends, in case you want to refresh all these concepts, I have also arranged that free of cost for you. All that you have to do is you have to visit tarunjagdish.com. Just visit my website. Here you can click on AFM pre-concept videos. So I have arranged pre-concept videos over here. All right. Once you come over here, look at this NPV, discount factor, cash flow. So whatever I'm saying, these concepts are actually covered in a much greater and much elaborate manner over here, friends. Logic of IRR. Then you have how to value an asset, logic of perpetuity, bond, what is the meaning, yield, first 3 formulas, YTM, average duration. Every concept is available over here, friends. If ever you want, you can always visit my website and you can learn these concepts also free of cost. Everybody clear with this part now? Yes. Now let me go to the next part. All right. So after this, the next part that comes over here is called as YTM, yield to maturity. So YTM is normally used for regular bond. A regular bond is having a limited life and it is having a redemption value. It is also having an issue price. So YTM, the formula is going to be coupon amount plus redemption value minus issue price divided by life whole divided by redemption value plus issue price divided by 2. This formula is an approximate IRR. In case you want accurate IRR, you can go for YTM after considering time value of money, where this will turn out to be your initial guess rate. Everybody clear with this part? Then we learned about average duration. Average duration basically means in how much time will I get my money back. So when you work out this, there are two ways of working it out. One is the table method and the second one is the formula method. In the table method, the formula goes in the following table format. Here, cash flow, discount factor, discounted cash flow, weighted average duration. For a zero coupon bond, whatever is the life of the bond will also be the duration because there is no other payments happening in between. But for a regular bond, your duration will keep on changing. Now, when you talk about average duration using formula method, the formula over here will be 1 plus y divided by y minus 1 plus y plus n into c minus y whole divided by c into 1 plus y whole power n minus 1 plus y. Everybody clear with this part? Fine. So here you can find out the duration. After duration, you can go and find out the volatility. The formula for volatility is duration divided by 1 plus yield. Everybody clear with this part? Then we go to the next chapter, which I call it as share valuation, or which was earlier in your books called as dividend policy. Okay. In that we learn about dividend rate, dividend yield, dividend payout. Dividend rate, the formula is DPS divided by face value. Dividend yield, the formula is DPS divided by market price. Dividend payout, the formula is going to be DPS divided by EPS. Everybody clear with this part? Then we learn an approach called as a common sense approach. This was asked earlier in the exam. Of late, they are not asking it much. But just for you to know, the formula goes like this. If the R, the actual return of the company, is more than the equity holder's expectation, it is always better to go for a 0% payout. But if R is less than KE, you should go for a 100% payout price. Everybody clear with this part? Then we learned about Gordon's model. As per Gordon's model, P0 is equal to D1 divided by KE minus G. This is nothing but the perpetuity formula, where instead of the formula of perpetuity, we use KE and we use the growth over here. Now tell me practically, how do you find out D1? D0 into 1 plus G. D0 is found from the audited financial statements. G is nothing but it is the retention ratio into the rate of return. Retention ratio is nothing but 1 minus payout ratio. Rate of return is nothing but PAT divided by equity plus reserves. Now when you go for Walters, K is found out using what? CAPM, RF plus beta equity into RM minus RF. Walters model. As per Walters model, P0 is equal to D divided by KE plus E minus D into R by KE whole divided by KE. Then we learned about MPS after dividend, friends. That is, if the MPS before dividend is 100, you pay a dividend of 4. MPS after dividend will be 96. MPS after bonus is nothing but market value after bonus divided by number of shares after bonus. Market value after buyback is nothing but a market value after buyback divided by number of shares after buyback. Yes, then we learned about stock split, reverse stock split. 1 share of 10 rupee is split into 2 shares of 5 rupees called as 2:1 stock split. 2 shares of 5 rupee being merged into 1 share of 10 rupees is called as the reverse stock split. Everybody clear? That's it. These were the 2 chapters that was homework for you. Yes, rights issue. Theoretical post-rights price is value after right divided by number of shares after right. Value of a right is nothing but MPS before rights minus MPS after right. Value of rights alone is MPS after rights minus the rights price. Then we also learned about a concept called as conversion value, etc. Friends, that concept I cannot explain over here. I have given you a question. That question also has a logic. Once you do that, it is very, very clear and audible to all of you, friends. I hope you are all absolutely and thoroughly clear with all these points now. Please type a yes in the chat box. I'm giving you a 1 minute of cool off time. Go through this. Whatever doubts you have, you can ask me your doubts now. Then we will move to the assignment part. Friends, like this, every week I'll come live. Every week we'll revise new topics. Every week I'll give you pre-revision. All right. Plus I'll give you assignments. I have given you my mastery book, but it's just free for the past students, chargeable for the new students who are joining for the mentoring program. And the video lectures are all available. Free video concept videos are available for you, friends. You can always learn AFM free of cost with the concepts what are available any point of time. But if you buy the book, you can learn everything on your own, friends. Are you clear so far? Yes. I hope I have clarified all the concepts so far, friends. If you have any doubts, please do let me know, friends. All right. Very happy that you're all clear with this part. Okay, Ambadi, you have a doubt. What is the actually the earnings growth model? How is it different from dividend growth model? A very good question, Ambadi. Ambadi, we learned that in this chapter of business valuation actually. I'll explain to you. When we speak about, there are two models. One is called as the dividend growth model, and the second one is what we call it as the earnings growth model. Dividend growth model, the formula is going to be D1 divided by KE minus G. Earnings growth model, the formula is going to be E1 divided by KE minus G. So here the logic is the value of an asset is present value of dividends forever. Here the logic is going to be present value of earnings forever. Everybody clear with this part now? Yes, fantastic. I hope you're all clear with this part now. Yeah. Very good. Takshinamurthy, it's only YouTube live this time because some students were coming on Zoom, some were coming on YouTube. They were facing some difficulty. So I thought of keeping it completely on YouTube this time, Takshinamurthy. Okay, Hashim, your doubt is that volatility is also called as modified duration. Steady material modified duration equation has n below the YTM. N is nothing but the number of years. Hashim, I'm not sure how they have put in the steady material. Can you please WhatsApp me? Basically, what is the formula for volatility? Duration divided by 1 plus yield. The same equation is what they have used for the word of modified duration. Okay. Hashim, if you can just send me an image in my WhatsApp, I'll give you my WhatsApp number also. If you can send me an image in WhatsApp, I can definitely clarify this for you. All right. Fantastic. So I believe that part is also clear, friends. Okay. Perfect. So friends, what I'll do now is I'll now go to the assignment part. Are you all comfortable so far, friends? Have you all understood the session so far? If yes, I just have one small request. Can you please like this video because I'm taking a lot of effort and the only purpose is that if you like this video, others also who are studying for CA final will find this video and they will also benefit from this. So for their benefit, I just request you all, if you genuinely have liked this video, please do like this so that others can also reach out on this one particular part. Now I will go to the assignment part, friends. So here I would have created an assignment. security valuation. 40 students have submitted, friends. Hats off to these 40 students. Shruti, Aarti, Adarsh, Aditya, Amala, Ambadi, Anchu, Anjali, Arpita, Bijitla, Bushaira, Gio, Jason, Jishnu, Jyoti, Kavya, Lijo. And just scrolling down, I think I won't be able to call all the four names. Maria, Meera, Hashir, Nazira, Navneet, Nishanti, Naureen, Priya, Ritvika, Rona, Shiv Shankar, Shivani, Soni, Sri Lakshmi, Sri Vidya, Subhi, Takshinamurthy, Varsha, Jain, Venkat Krishna, Yogaraj. Excellent job, each and every one of you. You have shown brilliant dedication. This you correctly do from today till the examination day. I promise you, you will score 70 plus in the exam. Okay, great. I'm approving all of you here. Now there are some 145 who are pending. My dear friends, I'm just scrolling your names down. Okay, wait. Or I'm not scrolling it down. 145 students haven't submitted the assignment. My genuine request to you, if you have joined this mentoring program, please take it seriously. I request you all to please give in your best, because if you have joined it, you have been given a study plan. You have to follow it. If you can't do it last week, do it the next week. Absolutely fine. But if you don't submit, you will not get the results that you're looking for. So I genuinely request all of you friends, please submit all your assignments over here. Okay. Yeah, Meera, you want to understand the concept of dirty price? Just check my YouTube. There's a video. Just search Tarun Jagdish dirty price. It will come. Okay, I have put a video on dirty price in YouTube, because many were asking that same doubt. I have put the full logic and the video on dirty price is available over there. Just search Tarun Jagdish dirty price. Yes, if you see over here, this whole problem has been solved, friends. So once you go through this video, you will be able to fully understand the logic of the dirty price. Is that okay? Yeah, Meera, please go through this, okay? Perfect. In bond valuation, yes, there is a question called as inflation premium increase by 2% means increase by CAPM. That question, Takshinamurthy, has a mistake in the study material. So what they have done is you just have to by heart and write it down, because that is the only way you will be able to get a grip on that particular question. That is not logical, so you can ignore that part, Takshinamurthy. All right? Perfect. Perfect. Yes. So friends, now I am putting in the next week's assignment over here. First week assignment is over. Second week assignment is portfolio management. This was supposed to happen by coming Wednesday, okay? So I did my live session a little late because I was held up with my classes at Trishur. Portfolio and mutual funds. You just follow my assignment. I assure you, you will get great marks. Mutual funds, ODB and mastery. Okay, do ODB 2 times, mastery 1 time. Deadline date is going to be Wednesday, 30th. The assignment has been created, friends. So will you all do this assignment? If anybody wants to join this mentoring program, just click on the playlist. I'm going to make it as a playlist. So the first mentoring program video will also be available to all of you. So I believe I have cleared all the points over here, friends. Shall we wrap up our session with this now? Please type a yes in the chat box so that I can wrap up my session. I also have a CA Inter FM mentoring about to start after this, friends. So if any of your friends are doing CA Inter, please do share this information with them. There is one more doubt, Maria. Yeah, Maria, that again is a mistake. Some questions you have taken ROE as KE. That's actually wrong. They should not do that. So you can assume that in that question, ROE and KE are one and the same. But in reality, ROE is R, KE is KE. Okay. Fantastic, friends. So let's wrap up our session now. Study well. I am also working with you. Let's study together. Let's win together, friends. Have a lovely time ahead. It was great meeting all of you. Take care, friends. Thank you so much. Have a nice time ahead. Thanks a lot.